Hello and welcome to Livewire Markets. I'm Ali Selby and today I'm joined by Aberdeen Standard's Head of Australian Equities, Michelle Lopez, as well as the firm's Deputy Head of Australian Equities, Natalie Tam. Today, Michelle and Natalie will be sharing their thoughts on the current market, as well as the themes that will be shaping portfolio returns in the future. Plus, they'll also share a stock tip or two. Thank you for joining me, ladies. First up, I'd love to know, and I might start on you, Michelle, whether or not right now is a good time to be an investor.
Well, if it's equities we're talking about, I believe so. And let me give you the fundamental reasons for that. There's two in particular. First, we've got fiscal policy. And fiscal policy at the moment is very loose, and domestically we're starting to see a rotation away from supportive stimulus that was put in place in the heat of the crisis last year towards growth stimulus, and in particular for businesses. And we're starting to see the data come out, very supportive, PMI, and we've also got consumer and business confidence at record highs over the last decade. More interesting though is really what we're hearing from the ground up. And that's our companies telling us that CapEx programs are back on the agenda. And that's across all the different sectors. So we have energy, we've got technology, we've got consumer. So people are starting and businesses are starting to reinvest. So that's very, very supportive. On the other side, we've got monetary policy. And if you think back, we all know that we've got interest rates at record lows, and it's our expectation that they'll remain there at least for the next 2 to 3 years, if not longer. If you recall back tail end of last year, the Fed came out and made an announcement saying that we are not going to adjust policy until we see that our two objectives are being met. And those two objectives are really about full employment and a sustainable inflation rate, annual rate of 2% or higher. Then our central bank, the RBA, came out in November and pretty much adjusted their framework to the same tone. So what implications then that has for investing and the markets more generally is that there is absolutely no incentive to keep your money or keep your capital in the lower risk asset classes such as bonds or deposits.
Or cash.
Or cash. I mean, cash is an incredible one because there are countries that are negative interest rates. And in fact, some countries like Denmark, most recently, are charging you to keep your deposits in the bank. So from my perspective, and I can't speak for Natalie, but it is quite an attractive time to be investing in the more riskier asset classes. And combining that together, monetary, fiscal, and then our expectation that the next 3 years we're going to see above trend economic growth is quite supportive for equities. I don't know if there's anything further to add.
I agree. I think what we're seeing from our listed companies and from an earnings point of view is growth rates that we've never seen before. And that's partly as a result of where we've come from. We've seen this big V-shaped recovery that we're coming out of. So there's that base effect that's helping earnings growth as well. But even looking through that noise, conditions are very strong. We've seen net positive earnings revisions for the past 8 months, and we haven't seen a string of 8 months of net positive earnings revisions for the past 2 decades. So conditions for businesses are very strong, and I think that does paint quite a rosy outlook for equities in general at this point in time.
What are you guys debating the most at the moment? Is there one subject or theme that is taking up a lot of your time?
We're constantly challenging each other across the team, and in fact it's something I welcome and I encourage, if I'm really frank. The real benefit of having a diverse team as we do is we all come to the table with very different views and approaches. And that's important because if this industry has taught us one thing, it's humility, and we don't always get it right, and we very often get it wrong, but we need to get back up and go again. And I think from a debate and a challenging perspective, my role and Nat's role is really balancing the short-term risks, the catalysts that we see, with the potential for alpha generation over the long term. So if I give you a live example, I suppose, is this kind of rotation that we're seeing playing out in the market at the moment. We have to take a view around its persistency and its duration. What are the risks within the portfolio and how, we want to be positioned. But at the same time, also think about if there's longer term opportunities in these growth companies that are now being overlooked by the market and perhaps being sold off as a general theme. And given our mandate is a longer term perspective, that's kind of the discussion and the debate that we're having. The other one's valuations. Valuations are always very topical for us. And what I think is cheap, or Natalie might not. She might think it's cheap for a very good reason, which is a structural reason, or there's unlikely for it to get out of this. Gold miners is a real live example of this. Some technology names as well.
Yeah, we've been spending a lot of time thinking about valuation. As Michelle mentioned, our assumptions on long-term interest rates are changing, and that can affect DCFs wildly, particularly for those high growth stocks in tech and healthcare, where we're expecting to see high growth for such a long period of time. The other part of valuation that we debate quite a lot is, what is our non-consensus insight? So if the market's expecting a company to grow at 5% for the next 5 years, and we think it's going to grow at 10%. How much conviction do we have behind that non-consensus insight? Because that's where we can really generate alpha. If we're just in line with the rest of the market, then we're not really going to have a point of difference, and we can't generate alpha from those kind of ideas. When you talk about it in that way, it's pretty black and white, but the reality is, there's many shades of grey, many different things to debate when it comes to valuation, and that's why we spend so much time talking about it.
Where do you think the headwinds are in the market at the moment, and also on the other side of the coin, the tailwinds?
The tailwinds, so I think to Michelle's point earlier, there's been a huge amount of stimulus, and Australia's gone early and really hard from a stimulus point of view, and that means that both households and the business sector is pretty cashed up. So if we look at household savings rates, they're up 5% to 20%. If we look at excess deposits as a percentage of GDP, that's sitting at 10% now. So there's a lot of cash to hand and a lot of savings, which I think is useful, because as we enter this fiscal consolidation phase where the government and the RBA starts slowly pulling back some of those stimulus measures, there's a cushioning effect. People can draw down on their savings to smooth over any fiscal cliff that there will be. The other kind of tailwind that we see is from low interest rates. The housing market is pumping pretty hard at the moment, and Michelle, you just came off a round of meetings with the big four banks, and you had some pretty staggering stats that came out around loan applications.
Yeah, so they're seeing 40% increase in loan applications. So there's a huge demand. The challenge, though, is converting those applications into drawdowns. And they're not seeing that convert yet. And that's really a bit of friction in the market around supply. There isn't enough stock of houses to be able to fulfil the demand that's clearly coming through.
Yeah, so it's just a bit of a lag effect. It takes time for people to put their houses on the market and get them ready for sale, and I think that will come through in time. So that's a considerable tailwind that we're seeing at the moment.
How about headwinds? Where are the risks in the market?
It's funny, and that puzzles to me because I'm constantly thinking about the headwinds. We have to be balanced here, because even though our central case is very much quite a constructive one, the headwinds are really kind of the tails that we see, and we need to be thinking about it, but also positioning a little bit for them. So I guess we've taken the view that maybe the easy wins have been had. So the deep value opportunity that we saw at the end of last year has played out. And we need to think about what next. And just to contextualise that a little bit, if you think back to November, which is when we saw the sharp recovery on the back of very positive news flow around vaccine efficacy, we saw the COVID unwind trade play out. And when you think about the sectors that were hit the hardest, you had the retail REITs, and you had travel. And in November alone, just to give you an example, Unibuy, which is the ex-Westfield shopping centres, Unibuy, Rodamco, Westfields, that was up 73% in 1 month. You know, that went from, and it was categorically cheap at that point in time prior to that. So it was trading at just above 0.2 times book. It's now at 0.8 times book, which we think is fully valued. And it's below book value, but when we think about the longer term outlook for bricks and mortar shopping centres, we think it's structurally challenged. Then you had travel as well. You know, Webjet was up significantly, 60%, Flight Centre up 50% in a month. So that's done. Now you sort of have to need to think about, okay, what's next in this part of the cycle? And we're starting to see some headwinds emerge. And headwinds in the sense of friction within supply chains, and also rising costs, and particularly wage pressure that's starting to come through. So there's some headwinds we've identified, but there's two big ones as well on top of that. The first is around this stop-start to COVID response. You know, whether it's Victoria at the moment, another sort of cluster forming, and what that means is really consumers and businesses don't have confidence to start investing, travelling, going out, spending. So that could really hamper the recovery that we're expecting. And then the third one's around trade. You know, China and Australia. China's a very important trading partner for us, and a couple of weeks back we actually saw that relationship deteriorate further. So China's pulled out of an economic development program, and that was really on the back of Australia pulling out of the Belt and Road Initiative with the Victorian state government. So given our reliance on China from an export perspective, I think that's another headwind.
Yeah. Are there any themes that you guys are noticing emerging in the market?
Yeah, so one of the themes that we're kind of currently quite exposed to is digitalisation. So we see that as a huge theme that has already persisted for a number of years and is likely just to be a multi-decade theme. So if you think about even what we've seen during the pandemic, you know, the onlineification of everything. We saw online retail sales growth within 1 year be the equivalent to 2 to 3 years. We saw triple-digit sales growth. We saw retailers that were just bricks and mortar and had never wanted to have an online store for fear of cannibalising their bricks and mortar stores suddenly have to launch an online offering. So these are huge trends. You know, the adoption of cloud, 5G, and what that will enable from the point of view of IoT or Internet of Things. If we can get exposure to companies that have businesses that will be exposed to these themes, then you know they're going to be propelled along with that growth as well. So they're the kind of opportunities that we're looking for at the moment.
There has been a sell-off in those kind of names over the last few months. Do you guys see that as an opportunity?
I think so. I think what the market has actually done, and what's been interesting in the last few weeks especially, is that the market has become more nuanced around tech stocks, and there's been a clear preference for those tech companies, those high growth companies that are actually free cash flow positive, and less of a preference for those companies that aren't yet at that self-sustaining free cash flow mark. I do think that this is a period of time where we're grappling with that question around inflation, and that's what's triggered that sell-off in the high growth tech names. But as we come through that, I do see it for certain tech stocks as being a pretty decent buying opportunity.
Michelle, are there any tech stocks that come to mind that you think have been heavily sold off that are due for a rebound?
Look, there's a few that we're looking at very closely. You know, well, couple in the portfolio that I can share is probably Altium is one of them, and Altium's an interesting one because they're in the sin bin a little bit in a number of ways. So they've had a couple of downgrades, but they've also been impacted by COVID. So they were kind of the opposite of what happened last year with technology companies. To Natalie's point, a lot of them just really shot up. And Altium didn't for a number of reasons. We're still very strong believers in the product, the embedded nature of it, the management team and kind of the long-term strategic value that's been created there. So I think that's one that we've been slowly picking a little bit more as it comes down. And the other one as well is Xero. I mean, Xero is one of those really high quality companies, and they just had a result and it was off 10% after the result. People got quite nervy around the margin. And again, to Natalie's point around cash flow generation, they have taken the view about building out the long-term value creation of the business, and they're clearly bringing customers on because subscriber growth is at record highs. But it's come at the expense of putting a bit more money in to grow that, and we're comfortable with that because we understand the business and what they're trying to do there. The other trend I'd point to more broadly is around sustainability. And sustainability is one of those, if you think about policymakers globally, they are looking for a more sustainable and a lower carbon world. And that has incredible implications across the entire opportunity set. So from renewable energy through to batteries and electric vehicles and environmental management. And, companies that offer technologies, for example, that are going to play into that trend. And this is not a domestic trend; it's a global trend. I think they're the ones that are going to really stand out over the next 5 years plus.
Well, that's a perfect segue into my next question. The team currently manages 2 equities offerings and has just actually launched a third. I know it's a sustainable option. Can you tell us a little bit about this fund and its mandate and what you're trying to achieve?
Sure. So yes, you're right. We launched a couple of weeks ago, and it's the Aberdeen-focused Sustainable Australian Equity Fund. This is a high conviction, all cap portfolio, and it's really investing in sustainable leaders and improvers, which is very important to note. The mandate is to have a lower carbon footprint than the benchmark, and in fact, at launch, it was 80% lower than the benchmark. We're excited because this is really an evolution of what we already do as a team. So we've embedded ESG into our analysis and investment process for the last 30 years. But for this fund specifically, we're really drawing upon the deep resource and intel that we have from a group around the ESG capabilities. So we've developed some in-house proprietary tools, so an ESG house score, a climate tool that we're really leveraging for the purpose of this fund. So the feedback so far has been strong, but I think there's a lot more colour we can probably add around the fund.
So Michelle mentioned a couple of the tools that we're using. They're in-house proprietary tools for this product. One of them is our in-house ESG score. So it's been developed by our global quant team and our central ESG team, which is our centre of excellence for ESG globally. And it uses over 100 different data points, both external and internal data points, to arrive at an ESG score for each company. And why we like it is that it's completely proprietary. It can't be replicated by anyone else. When we look at the market today, a lot of our peers will use an external third-party ESG provider to provide ESG scoring, something like an MSCI or a Sustainalytics. Yeah. And that's great, but it's a data feed that everyone can get access to. So where's your edge, essentially? And so we would view, as an example, an MSCI ESG score as providing the consensus view of what an ESG score is for a certain company. So to generate alpha, we need to know where we're different. And that's what this score allows us to do, as well as our fundamental research that goes around that. The other part that Michelle mentioned was around our carbon footprint of our fund, which is 80% below the benchmark at this point in time. And we've launched a climate scenario analysis tool this year, and this is a groundbreaking tool. We've had companies approach us, listed companies approach us and ask, how we've actually done our modelling. And what it does is it allows us to run 16 different climate scenarios. So for instance, a Paris-aligned scenario at the very top level, take that scenario, translate it into an economic shock, like a carbon tax, and then it generates an impairment or an uplift in the valuation at the stock level. So the ability to take a macro level shock and break it right down at the stock level is really quite quite unique and it is challenging. A lot of the super funds that we talk to are struggling to come up with a single climate change scenario at this point in time. So that's what we're using for across all of our portfolios at Aberdeen.
Are there any companies that tool has uncovered that perhaps have surprised you, that you didn't expect to be winners in that kind of scenario?
So interesting, when we run our central scenario for climate change scenario analysis across the ASX 200, the most affected and most highly impaired company is, and it probably won't surprise anyone, is AGL. And we've just seen AGL announce a big restructuring of their business because I think, at the end of the day, that board and management team can see the future and the way climate scenario analysis and policy is changing, and they need to do something at this point in time to pivot the business, in a sense, to try and address that impairment risk that is there.
That's a loser. How about a winner in that kind of situation?
Yeah, the winners are definitely, and this is a very good question because I think what the most important takeaway from climate scenario analysis is that it's the dispersion of outcomes at the stock level, which is the most important thing to focus on. If you're just looking sector by sector, it kind of hides these dispersions. But the real winners that we're seeing are renewable energy generators. Under almost all climate scenarios, these do really well.
Why now? Why launch this strategy now? What was your road to Damascus moment?
Oh, look, I think Natalie speaks to this really well, but if in an absolute nutshell, it was client demand. It's, every conversation that we're having with clients, and particularly the institutional side, involves two things: sustainability and climate.
I think if you look back over the last 12 to 18 months, the focus on ESG and sustainability has accelerated. If we were looking at an S-curve, you can definitely see that we're in the accelerating part of that S-curve now. And why is that? There's been pressures from numerous fronts that are really forcing companies, our listed companies, to look at ESG and sustainability, and also our clients. So if you look at governments around the globe, they're changing the way they think about climate change as well. You've seen China come out with its 2060 target to be net neutral. Now, the pathway that they get there is up for debate, but it shows intention. In the US, you've got President Biden also having a big number of projects to try and reduce the impact that we're having on global warming. If you look at regulation, in Australia, we've got the Modern Slavery Act, which is forcing companies above a certain size to go back and audit their supply chain and look at the high risk points and put in plans to address where there might be risks around slavery. We've had APRA come out and recommend to insurers and banks to look at climate change, and for that responsibility to be taken at the board and senior management level. So this is not, the time is long past now for taking a head in the sand approach to climate change. The time is now to address that. And then, as Michelle mentioned, on the asset owner side, every single super fund that we speak to wants to know about sustainability and climate change and how we're managing that risk in our portfolios. And then the final piece, which I find personally fascinating, is social movements and social change and crises that we've seen. So we've had Black Lives Matter, we've had the Me Too movement, we've had the terrible Australian bushfires, and we've had a global pandemic. And all of these things actually cause a deeper questioning around profitability. It's not just profits at all costs, it's sustainable profits, and sustainable in every sense of the word. And it's fascinating when you look at corporate crises in Australia, and we've, where we were 5 years ago to where we are today has changed dramatically. And so what we see sometimes, though, is crises erupt, and I don't want to point fingers, but there's been quite a few in the last 12 to 18 months. Companies like AMP, Rio Tinto, and we've seen boards responding where they think community expectations are, but they're still kind of living 3 years ago. And that unwind is happening now, and boards are very aware of the missteps of their peers and are changing, which is good. I think the change is overdue.
Yeah,
and we're starting to see also asset owners talk and act with their money. And if you actually look at the flows into our market, and the Calastone network's quite an interesting one. They put out a report at the beginning, I think it was a month ago. And if you look at flows going into this part of the market. It's remarkable. So $84 of every $100 in equity funds have gone into sustainable or ESG funds over the last 2 years. And that trend, to Natalie's point, is only accelerating. If you consider the last quarter of last year, we saw more flows than we did for the whole of 2020 and 2019 combined. So there's serious money now going into these type of funds and solutions.
Moving away from sustainability for a little bit now, if there was another correction or a massive sell-off like we saw in March last year, is there one stock that comes to mind that you would snap up at a discount?
Yes, there's quite a few actually that I would snap up at a discount given the opportunity. So, if there was a broad-based 20% fall in the market, I would be picking up something like Tyro, which is a payments company. So if you go down to your local cafe and buy your $4 latte with your credit card and tap onto that terminal, Tyro is more than likely to be the one providing that terminal. And what we saw over COVID is that obviously retail and hospitality venues were heavily impacted during those lockdowns. And so now we're comping that really low growth rate. And so as we exit out of those lockdowns and as normal life returns, we're seeing a lot of transaction value going through those terminals. So Tyro was a really clean COVID recovery play. But in January, it had a bit of a problem with a terminal outage. So if you went to pay for your latte, that terminal wasn't working, and it affected about 30% of their merchants. So it was significant. And the question there is, and this is why it's quite a divisive stock, which is good. We like divisive. That gives us the opportunity to earn an outsized return, which we love. The question is whether that outage is going to cause long-term damage to reputation, the ability to win new customers, and whether the existing customers churn. Now, I think the management team's actually done a really great job in, remediating their book and fixing the glitches and going out and rebuilding trust in the community. So I think that while there is going to be some impact, it's probably going to be more muted than what the market's expecting. The other one that I would buy would be something like Temple & Webster. It's an online retailer. It's really been exposed to that acceleration in online adoption for shopping for furniture and homewares. When I think about its management team, they really remind me of the Afterpay team. They're just laser focused on what they do. It's about doing 100 things really well and not kind of deviating from their lane. I like the balance sheet. I like the business. I think if you think in 5 years' time, I'm a strong believer that its sales line is going to grow by multiples. So I would be buying that business. It's in a funny moment in time at the moment where it's comping, triple-digit sales growth. So, when you're doing sales up here, can you actually grow on top of that when you come around on the next year? They have been able to for April, which is a good sign, but I think there'll be a bit of volatility. We might get our chance to buy it on a 20% fall. The other thing that I think we've learnt over 15, 20 years of investing in equity markets is when there is a big correction, people just flock to the safe, steady Eddie defensive names. So if there was a 20% correction, I would be rotating a little bit into something like Spark New Zealand, which is New Zealand's telco operator. It's got a 5% yield. It's got very low earnings volatility, and during crisis times, we need our mobile networks, don't we? So that's something that I know would outperform in a really high volatile market.
Both of you have worked together for quite some time. What inspires you to succeed in investment management?
Oof, big question. Look, I personally find inspiration in lots of different ways. I find inspiration in my colleagues, people that have done this in the past, and the other part of it is also children. I've got 2 young girls, and I say girls because we're in the industry, as we well know that female representation isn't huge. So I find inspiration in them to just keep going, because it's pretty ruthless, and it's a lot of grit that is required to succeed. And you're right, Natalie and I have been working together for over 15 years, and we've been through some pretty hairy moments, but you just stick it out because that's our character. That's certainly what we've learnt. And at the end of the day, it's hard work, but it's damn rewarding.
Yeah, I agree. Absolutely.
And just finally, I'd like to end on one piece of advice that you think could really help investors.
I would say don't invest with emotion. That's really hard. So probably just know your own emotions, understand how you respond to things. If you are feeling really scared, that's probably a buy signal. Something I've learned about myself.
Yeah, I think the other one is just get back up. Every single one of us, whether you've been in the markets for 20 years, 50 years, we all make mistakes, and what do learn from those, and can you apply it to something else? So get back up and give it another go. But to Natalie's know your restrictions and know that. But that's probably the biggest one. The worst thing you can do is go, oh, I've tried it and it's not for me and I've burnt some money. But I think just get back up.
Yeah, well, thank you so much. It's been such a pleasure to talk to you this morning. Thank you.
Thanks, Ellie.
It's been great. Thank you.